In the fast-changing world of finance, whispers of uncertainty hint at a potential disaster that could send the stock market on a downward spiral by a staggering 50%. What's fueling this potential crash? From rising inflation to political tensions and post-pandemic economic trouble, there's a massive storm brewing that may have the power to change the market as we know it. So buckle up as we dive deep into the twists and turns of this potential crash and how it could reshape the investing landscape in the months ahead. Let's dive right in. You know that feeling when the air gets a bit heavier and there's a subtle shift in the stock market's rhythm. These are indications that a storm is on the horizon. The most common signs of a potential crash are crazy stock price fluctuations, rising interest rates, and declining home sales. Other warnings are rising global tensions, supply chain interruptions, and a sharp decline in investors. It's important to keep in mind that forecasting market crashes is a difficult task that comes with uncertainty. Even if you start picking up on these signs, the direction of the market can still change at any moment. It's recommended that investors handle these potentially turbulent periods with confidence and resilience so they can remain on track to earn as much as possible. It's important to pay attention when these signs start to emerge and grab an umbrella before the rain arrives. Whether you're an experienced investor or you're just getting started, remain alert, keep a lookout, and get ready for any twists and turns that may appear. I'm no fortune teller, but there seems to be a general sense of unease pointing to a possible crash in the market. You may find yourself asking, why is everyone tense? Well, as prices continue to rise, inflation is creeping in. Not to mention, supply chain issues are negatively impacting the market's current direction. This spells a recipe for disaster, especially when you take into account the current political situation in the Middle East. Fears of tighter monetary policies from central banks due to the recent spike in inflation may result in lower company earnings and consumer spending. If you take the COVID-19 aftermath and labor shortages into account, it doesn't look good for us. Investors tend to become uneasy when fear begins to spread like wildfire. Like dominoes, as one falls, the others follow. While I'm not advocating for anyone to panic just yet, having a bit of wisdom never hurt anyone. Even if the market crashes 50%, perhaps this is just a blip on the map, and we'll overcome it and emerge stronger. Time will tell. Although the COVID-19 pandemic is considered to be over, its effects are still felt in the financial markets. The stock market is facing difficulties as a result of the pandemic's aftermath, despite early expectations of a quick recovery. The potential for the world economy is tainted by rising inflation as a result of the 2020 shutdown, and there are also questions about how long the recovery will last because industries like retail, hospitality, and travel have been hit hardest by the pandemic's effects. Lack of clarity is only increased by supply chain interruptions, rising interest rates, and inflation, making things worse for investors. Investors are using a variety of asset classes and innovative investment strategies in the unstable post-pandemic environment to reduce risk and take advantage of new opportunities. The popularity of alternative assets like real estate and cryptocurrency is growing as investors look for ways to diversify their portfolios and get ahead of inflation caused by the pandemic. In reality, the pandemic's long-term repercussions are still influencing world markets, even as its immediate effects are starting to fade and things are returning to normal. To navigate the post-pandemic market, you have to work carefully with a proactive strategy and, of course, an optimistic outlook. The development of AI and advanced technology is changing how investors see and engage with financial markets. Trading tactics have undergone a revolution because of AI-driven algorithms and advanced machine learning techniques. This allows investors to evaluate market patterns and make judgments with speed and precision never seen before. These AI systems are capable of sorting through massive amounts of data to find patterns, correlations, and similarities that human traders would miss. AI algorithms are progressively impacting market trends and investor behavior because of all this new information that's being processed at a record-breaking level. Many investors worry about market manipulation and algorithm bias as potential unintended effects of AI in the stock market. As AI technologies develop, market investors and regulators will need to consider the pros and cons of this major technological shift. They must make sure that the advantages of AI are weighed against precautions to preserve investor trust and the integrity of the market. Human monitoring and judgment are still necessary in this quickly changing environment to successfully navigate the complexity of the current situation. The prolonged war between Israel and Palestine has had an effect on many different sectors and industries and creates a level of uncertainty about the world's financial markets. Since markets can become messy during the unpredictability of war, escalating tensions in the Middle East are already having an impact. The energy market is one sector that is especially vulnerable to the effects of the conflict because the Middle East is a major oil-producing region. Industries that depend on oil and gas may see supply chain disruptions and price increases if there are any delays to oil production or transportation routes. And if that happens, it will have a ripple effect and the market may begin to show signs of crashing. But here's the kicker. Although it may negatively impact the market, it can also benefit it in a way. Sometimes, crises like these have been known to create new opportunities. For instance, defense stocks might see a boost as countries beef up their military spending. So while the situation in the Middle East might seem far removed from your daily life, its impact on the stock market is real. Stay informed, stay vigilant, and who knows, you might just come out ahead. Are you wondering if things will ever improve? Well, the stock market's trajectory is naturally unpredictable, as it is influenced by a wide range of factors. While there's always a chance of a market crash, there is also the chance for progress and recovery. Sharp drops in stock values or market crashes can be caused by political unrest, economic issues, or unusual situations like the COVID-19 epidemic, for example. But as history has demonstrated, markets are remarkably resilient. They frequently recover from hard hits and crashes. Central banks and legislators have enacted policies to stabilize the economy during times of hardship, which includes asset purchases and interest rate reductions. These actions can aid in reviving the financial markets, which expedites the recovery process. Now, we've covered a lot today, and it's time to wrap things up. I know that we've been talking a lot about the possibility of a stock market crash, and let's be real, it is a scary thought. But here's the thing, fear can be a powerful motivator, even though it can cloud our judgment. So instead of letting the fear of a crash paralyze us, let's use it as fuel to take action. First things first, stay informed. Knowledge is power, and the more you know about what's happening in the world, the better equipped you'll be to navigate these uncertain times. Second, don't panic. Yes, the prospect of a 50% crash is intimidating, but remember, the stock market has a history of bouncing back and recovering. And remember to like, subscribe, and ring that notification bell for future updates.